Building upon the critical fiduciary duties of handling trust accounts, the next fundamental component in property management compliance is the property management agreement. This agreement establishes the legal and fiduciary relationship between the property owner and the designated broker, or their authorized property manager, clearly outlining duties, authority, compensation, and responsibilities during and after the management relationship. Under Arizona law, the property management agreement serves as both a business contract and a compliance document governed by ARS Section 32-2173 and the Arizona Administrative Code R4-28-1101. A property management agreement must be in writing, signed by both the property owner or their legal representative and the designated broker, and must clearly define the scope of authority granted to the broker. This written requirement protects all parties by setting clear expectations and avoiding disputes regarding control over funds, repairs, and leasing decisions. According to ARS Section 322173A, no licensee may act as a property manager without a valid written agreement that delineates all duties and obligations. This statute is essential because the agreement formally establishes the fiduciary relationship, much like a listing agreement does in sales transactions. The minimum content requirements of a property management agreement are further defined in ARS Section 322173. These requirements include identification of the property being managed, including the address and legal description, duration of the agreement with specific start and end dates, terms for renewal, termination, and notice provisions, responsibilities of the broker and property manager, such as collecting rent, arranging repairs, conducting inspections, and maintaining trust account records, owner's obligations, including providing maintenance reserves and funding for authorized expenses, management fees, commissions, or compensation structure, procedures for handling tenant security deposits and owner funds, authorization for the broker to sign lease agreements or make disbursements on behalf of the owner, when applicable, clear explanation of the disposition of funds and records upon termination. For example, suppose a property owner hires a broker in Tucson to manage a 12-unit apartment complex. The property management agreement must specify whether the broker is responsible for tenant screening, maintenance coordination, and collecting rent, as well as whether the broker has the authority to hire vendors and pay bills. The agreement might also state that the broker will deposit all rent payments into a designated trust account and remit net proceeds to the owner monthly after deducting management fees and expenses. Upon termination of a property management agreement, whether by expiration, mutual consent, or for cause, specific obligations must be fulfilled to ensure compliance and protect both the owner and the tenants. The property manager must 32-2173C. On termination of the property management agreement, the property management firm shall provide the owner with a final accounting of the property's financial status that includes, at a minimum, 1. Within 5 days, a list of all tenant security obligations. 2. Within 35 days, reimbursement for all monies remaining in the property accounts maintained by the property management firm, except for monies needed for unpaid obligations incurred during the term of the property management agreement. 3rd, within 75 days, a final accounts receivable and payable list. 4th, within 75 days, a final bank account reconciliation. Deliver all money held in trust to the property owner or the new management company within a reasonable period, typically within 5 business days of termination, unless otherwise agreed in writing. This includes rents collected, tenant security deposits, and any unpaid owner funds. Provide a final accounting to the property owner that details all receipts, disbursements, and outstanding obligations up to the termination date. This accounting must reconcile the trust account balance with the property's ledgers. ensuring that no client funds are withheld without authorization. Transfer all original property management records, including tenant leases, maintenance records, inspection reports, and accounting documentation. The broker must also maintain copies of these records for at least 5 years as required under ARS Section 32215 1.01a for audit purposes. Notify tenants of the management change and provide updated payment instructions. Property managers must ensure that tenants are informed of where to remit rent and to whom maintenance requests should be sent to avoid disruption of services. An illustrative case highlighting these duties is in Re Mason Property Management, ADRE 2014, where a property management firm failed to transfer tenant security deposits to a new manager within a reasonable timeframe after contract termination. The Arizona Department of Real Estate determined that the delay constituted a violation of ARS Sections 32-2151, 32-2153, and 32-2174 for failing to maintain control and accountability of client funds. The firm's broker received a fine and mandatory remedial education, demonstrating the seriousness of post-termination compliance. A well-drafted management agreement also prevents misunderstandings when an owner chooses to terminate services or switch management firms. For instance, if an owner sells the property, the agreement should clearly state whether the contract terminates automatically upon sale or transfers to the new owner. It should also outline any termination fees, ensuring compliance with Arizona contract law and ADRE standards. Review summary. A written property management agreement is a mandatory legal document that governs the relationship between a property owner and the designated broker. Under ARS, Section 32-2173, and related ADRE rules, it must specify duties, compensation, the handling of trust funds, and the conditions under which the agreement may be terminated. Upon termination, the property manager must promptly deliver all client funds, provide a final accounting, and transfer records to the owner or new management. Failure to comply may result in disciplinary action under Arizona Revised Statutes, Section 322153. A clear and compliant agreement ensures transparency, protects client assets, and upholds fiduciary integrity in Arizona's property management industry. Discussion prompts. Why is a written property management agreement required under Arizona law? Answer. To establish clear fiduciary duties, protect both the property owner and broker, and ensure compliance with ARS. Section 32-2173. What must a broker do with trust funds and records upon termination of a management agreement? Answer. The broker must transfer all funds, provide a final accounting, and deliver records to the owner or new manager promptly. Why must property managers retain copies of records for at least 5 years after termination? Answer. To comply with ARS Section 32-2151.01a and ensure documentation is available for potential audits or legal disputes. Closing remarks. Property management agreements form the backbone of lawful property management practice in Arizona. They define fiduciary duties, clarify authority, and protect client relationships by providing written accountability. When an agreement ends, professional handling of funds, records, and tenant communication reflects not only legal compliance, but also ethical stewardship. Brokers and licensees who honor these obligations strengthen public confidence in the real estate profession and reinforce the integrity of their brokerage operations.